It is now my pleasure to turn the webcast over to Keith Schmidt, EVP of Premier Wealth Management. Mr. Schmidt, you may begin.
Well, thank you very much. Good morning, everyone. My name is Keith Schmidt, and I'm the Executive Vice President and Manager of our Premier Wealth Management Group here at Zions Bank in Utah and Idaho. Premier Wealth Management focuses on the specialty or custom offerings that we provide to high net worth individuals, things such as trust services, insurance services, financial planning, investment management, and of course, traditional private banking functions. I'm so glad you could join us this morning for the presentation of Retirement Planning 101 and our guest speaker, Rebecca Robinson. Give me a moment to introduce Rebecca to you and tell you a little bit about her background and credentials. Rebecca Robinson is the president of Zions Trust and the managing director of our wealth planning group. As such, Rebecca focuses on leading our trust and financial planning professionals. In the industry, Rebecca has over 16 years experience, including a long tenure with PricewaterhouseCoopers on the East Coast in Washington, D.C., and Wells Fargo in Dallas, where she managed their financial planning function for the Western region or West Coast. Some of Rebecca's credentials include being a certified financial planner, a certified public accountant, and she holds a master's in accountancy and a bachelor's in accounting from the University of Utah. It's my pleasure to introduce Rebecca Robinson and highlight our presentation this morning on Retirement Planning 101. Rebecca?
All right. Thank you very much, Keith. What a wonderful introduction. I want to thank everyone for joining us today. We know retirement planning is on the minds of many people, not just people who are getting ready to retire, but people who are maybe 20 or 30 years out as well. So we're going to spend about the next 45 minutes really talking about retirement from a planning perspective. Not so much products or how you invest your money, but more so, what does your retirement planning roadmap need to look like? So as we start to think about retirement, one of the things that I encourage the clients that I work with to do is really picture what you want that to be. If we look back even 20 or 30 years ago, if an individual retired at 62 or 65, they may have only had a few years of life expectancy left, and retirement wasn't necessarily an active pursuit of activity. Now when we look at retirement, I think a lot of people view it as what they hope to be a happy time, a reward for a lifetime of well-spent work, looking at things like enjoying travel, enjoying some time at home, maybe an opportunity to go back to school and pursue another profession. The thing is, with these longer, healthier lives, that also means that we may very well spend a lot more time in retirement, which can also lead to stress for people as they try to think, how do I plan for my money to last? So when we think about retirement, the length of retirement and our desire for a different type of retirement lifestyle makes planning for it essential. So today we're going to think about retirement as a retirement planning roadmap. When I think about a trip across the country or perhaps maybe the biggest trip of your life, I don't think any of us just go hop on a plane and head out and hope for the best. Or if you do, you're a very free spirit. When we think about the biggest trip we may ever take, we put a lot of time and thought into planning and research. We map out the trip. We determine what to pack, what might the weather look like. Yet, nevertheless, a remarkable number of people don't take the time to map out 30 years or more that it can realistically take to achieve your retirement goals. So when we start to think about this, it may help you to think of your roadmap with retirement as the destination and the roadmap as to how you will get there. And in constructing this roadmap, we'll talk about why it's so important to start planning now. We will look at some of the basic questions that you may have, such as what kind of retirement lifestyle do you want, when do you want to retire, and how long will that last. We'll talk about how to come up with an investment plan by crunching some numbers. We'll look at tax-efficient and tax-advantaged retirement vehicles. We'll look at some general investment considerations. And then we'll look at how you can help protect that plan against undue risk. And finally, we'll look at how you go about implementing that plan. So there is the old saying, when is the best time to plant a tree? And it's 20 years ago. When's the next best time? It's now. So when we think about planning for retirement, I always encourage people not to get discouraged by wherever they are, because we have to start where we are. But if you have the benefit of time on your side, I can't stress enough to start now. When we think about it, I hear a lot of people say, I will start saving when? I'll start saving when I get a raise. I will start saving once I've bought a house, once I get married. The truth is you can never make up for the lost time when you put off starting to save for retirement. So the further off retirement is, the more time your investments have the potential to grow. And if you wait too long, it makes it very, very, very difficult to catch up. So if we look at this example, if we take $3,000 and we invest it every year starting when you're 20 years old, if you retire at age 65, you will have accumulated almost $680,000, and that's assuming a 6% annual growth rate. If you wait until age 35 to start saving that same $3,000 annually, you'll only accumulate about $254,000 by the time you reach age 65. And if you wait until age 45 to start saving, you'll accumulate only about $120,000. So this doesn't mean there's no hope if you're 50 or older, but if you haven't set anything aside for retirement, it's just going to make it more important that you implement a plan starting today. The other thing is, as you age, the rate of return on your investment becomes more important, where when you're younger, just the very act of saving alone is a huge determinant in where you will get. So as we think about retirement and the decisions that you have to make, there are really some basic considerations to look at. And if this is a long ways off, this may seem difficult, but I don't think it's ever too early to start planning. The first one being is, what kind of retirement do you want? The second one is, when do you want to retire? And then 3, how long will retirement last? So let's look at each of those questions. So the first one, basic considerations, what kind of retirement do you want? At the very beginning, I asked you to sort of think about, what do you picture when you think of retirement? And whether you pictured yourself on a golf course, if you pictured yourself in your own living room, maybe you thought some sort of other activity, but always we would hope to consider ourselves with some level of financial independence. I don't think many of us ever plan on retirement and thinking of ourselves as being a burden to the people that we love. To a large extent, maintaining financial independence depends on the lifestyle that you want. And I think describing that retirement lifestyle and how you imagine living in that. Are you going to stay in your current home? Will you downsize? Do you want to purchase another home? Do you want the opportunity to provide for your children and grandchildren in your retirement years, and what does that look like? And in a moment, we're going to look at how you go about determining the cost of that retirement, but let's first look at some other basic factors you'll want to consider. So factor number 1, when do you want to retire? This is really, really important, because the earlier you retire, the shorter period of time you have to actually accumulate assets, and the longer period of time we'll need those assets to go. Although you can retire at any time, most people wait until they're eligible for Social Security retirement benefits. You can't start receiving Social Security before the age of 62 unless there are some widow's benefits and disability benefits. But just as a general rule, 62 is the earliest you can receive a full Social Security, is the earliest you can receive. And a full Social Security benefit isn't available until age 66 or 67, depending on the year you were born. I think this is a really, really important topic, and I want to stay on it for a minute. A lot of people used to just automatically take an early benefit. At age 62, they wanted their money and they took it. So by taking that retirement benefit early, you'll lock in about a 25% reduction in benefit, and you will lock that in for your entire life. But an even more interesting calculation that needs to be looked at now is the difference between full retirement age, so age 66 or 67, and delaying taking your benefit until age 70, even if you have stopped working. That delay every year gives you an additional 8% in benefit. And this break-even used to come out and say, well, maybe at 80 or 81, maybe you break even then, or where does a couple break even? And people would say, well, my life expectancy isn't that long. the reality is, and we'll touch on this in a bit, life expectancies are getting significantly longer. So that break-even analysis and the benefit of delaying is really, really important. So when you're making this Social Security decision, please get some advice, and a lot of even, unfortunately, what you see out in popular press has a lot of error in it as well. So make sure that you're putting a lot of thought into that benefit, because some of these decisions that once you make them, you only have a short window to change your mind, and then you're otherwise locked in. So the next consideration is, how long will retirement last? And when we think about that, if we all knew exactly how long we live, it would be very easy then to plan out how long all of our money would last for us. So if we talk about life expectancy, according to the National Vital Statistics Report for May of 2013, the average 65-year-old American can expect to live for another 19.1 years. So you think about 65, the average essentially makes it to 85. We're also finding that those life expectancies are steadily increasing, and they are expected to continue to increase. So in 2010, the Census Bureau reported over 53,000 Americans who are over the age of 100. So the point I want to make there is that for many of us, it's not unreasonable to plan that retirement may last 25 years or more. And that's when we start to crunch the numbers. So we talked about lifestyle, and one more point on lifestyle as well. If you retire at 65, one of the rules of thumb, and it's hard to plan around, but sometimes people will say, I want to spend $30,000 a year traveling. Keep in mind that the lifestyle you live from 65 to 75 may very well be different than the lifestyle from 75 to 85, and will most certainly be different from 85 to 95. So part of this, too, is I don't want people to plan themselves into the poorhouse early. Your spending will change, and we'll talk about what you need to prepare for and how that will change, but also understand that lifestyle itself will likely change as you age. Let's discuss now how to go about estimating what your future retirement expenses, and then talk about projecting your retirement income. And this will help you then say, what's my retirement gap? Accumulating enough funds to close that gap is really the ultimate investment goal, and we're going to talk about how you can make some assumptions and begin to calculate what that investment goal needs to be. But before we move forward, one more piece, let's talk about the effect of inflation on your spending. So one of the rules of thumb you'll hear out there is that essentially you'll need 60 to 90% of your pre-retirement income for when you retire. And although this is an easy way to do it, I don't find it to be particularly accurate. Most of the studies have shown also for higher income Americans that often early in retirement they're spending 110 to 120% of what they were spending before. So just automatically saying I will spend 60% or 80% because it's a rule of thumb is a very broad sweeping thing, and we like to say we'd rather have you make that more specific to your own experience, your actual expenses, and the things that you think you would like to do in retirement, so your plan actually is tailored to your needs, not just a broad rule of thumb. And then obviously the further away from retirement you are, the more difficult it is to look at this, but try and start detailing out your potential expenses. And some things to think about. Your housing costs may decrease if you've paid off your mortgage. You will likely pay less in overall taxes, but that isn't always a guarantee. You may eliminate costs that are associated with your current job, commuting, clothing, things like that. You will likely pay more in health care costs, particularly if you retire before you're Medicare eligible. You will likely pay more in entertainment expenses, dining out, other things as you have more time. And then also you may want to estimate the inclusion of things that will help support your children and your grandchildren, education, health care, travel, any of those things that are important to you. Make sure that you count on those as you look at the numbers. So as we estimate your retirement income, traditionally we've talked about retirement income as this three-leg stool. And the three legs of that stool are Social Security, traditional employer pensions, and then individual savings and investments. So Anymore, fewer and fewer individuals actually have a traditional employer pension. And when we think about this stool, the analogy doesn't really hold up anymore. It used to be Social Security covered about 40% of the gap, your employer pension covered 40 to 50%, so you were really looking to your personal savings to cover maybe 10% of that. If you take that 40 to 50% out, your personal savings will be covering a much, much greater piece of this. Everyone can access a statement from the Social Security Administration on their website at ssa.gov. You'll want to pay attention to your benefit estimate for a couple of reasons. First, you want to make sure that the information they have is accurate. And then second of all, it will give you an idea of what you can plan to expect if you keep your current work history, what to expect at age 62, what you could expect at full retirement age, and then also what you could grow to expect at age 70. So the good news there is that Social Security will provide a monthly benefit, and when you think about that benefit, depending on when you take it, that guaranteed income stream is much like a $1 to $2 million investment account, as that's the amount of principal it would take to generate the type of income that a lot of people get from Social Security. So please be very thoughtful about your decisions there, because it is a very meaningful piece, and if you put it in investment dollars, it helps give you some perspective about what that's actually worth. So when we talk about it filling that gap, I do think it's important to say it won't fill all of it. So if we think about, if we look at an individual born in 1957 who's made $70,000 a year, they can expect to receive somewhere around $24,000 a year at full retirement age, which in this case is age 66 and a half. Your actual benefits depend on your work history and your retirement age, but as you can see, there's still a very large gap there. So when we say that we have fewer and fewer traditional pensions, then the next question becomes, what do we do with our investments to fill the gap, and how do we determine what that gap looks like? So let's go ahead and pause and try and tie some of this together. We've talked about estimating our annual expenses for retirement, and we've talked about estimating our annual income in retirement. So with very few exceptions, most of us are going to find that we have a pretty significant gap between what we think we're going to have and what we need to live the retirement lifestyle we want. So the gap represents the amount of additional income we're going to need to make up for with our savings and our investments. For example, if we estimate that we need $50,000, it's taking its sweet time to come up there. There we go. Each year to live in the retirement lifestyle we want, and we want to count on Social Security to provide about $20,000 of that. That means we have a $30,000 shortfall. And if we're planning a retirement that lasts 25 years, we'll need $30,000 each year for 25 years, or we're going to need a total of $750,000 to fill that gap. So now, let's look at calculating your entire retirement investment goal. This retirement plan should have one primary goal, and that's to accumulate enough assets by the time you retire to satisfy your projected income shortfall. So once you've actually quantified what that shortfall is and you know how long retirement likely will last, then the number itself is actually a pretty straightforward calculation. You do want to keep in mind that even though you'll be using your investments during your retirement, that the remaining funds will still be working for you, and they should hopefully be growing. One of the biggest mistakes I see people make is they retire and they want to get extremely conservative with their investments. When we talk about retirement lasting 25 years, please keep in mind some portion of that portfolio needs to have a 25-year time horizon. If we pull it too conservative too soon, you've lost the ability for that to continue to grow during your retirement. So you always need to assume a reasonable rate of return, and then you also need to remember that this is an estimate and there are no guarantees, and there are years where you will actually lose money. If we think back to 2008 and the lost decade, a lot of people are still in the workforce because of the hits that their investment portfolios took during that time. So for example, let's say I'm going to need an additional $30,000 for my retirement, and I plan 25 years, and I assume that my unused retirement funds will grow at 6% a year. To get that $750,000 number we talked about, what we need is approximately $384,000 at the time we retire. So now let's talk about how you go about building that lump sum, and we'll talk about for the remainder of this discussion. Although, let's go back. We have one more number crunching topic, and that is the effect of inflation. So inflation essentially reduces the purchasing power of the dollars you have over time. If we look over the last 20 years, inflation has averaged at about 2.4. I think a lot of people on the phone can remember when inflation was clicking off at 14 and 15%. We've been in a fairly low inflation environment. But when you think about it, if you say at 2.4% annually, something that cost $100 today would cost $167 in 20 years. When we look at the inflation numbers around health care and long-term care, they are far outpacing standard inflation, and I think that's a real source of concern for a lot of retirees. So if we look at the calculations we've discussed so far, we've ignored inflation. But when we're talking about retirement lifestyle, we're concerned about keeping that purchasing power. So that means we are going to need to adjust our calculations for the impact of inflation. So let's just say, for example, you invest $5,000 a year for 30 years. If your investments grow at 6%, you'll end up with about $395,000. Now let's assume a 2.4% inflation rate. That means that each annual contribution of $5,000 is worth less in terms of today's dollars. So it also means that your investment growth has to not only outpace inflation, but it needs to grow and outpace inflation both. So in this example, after 30 years, your $395,000 has the purchasing power of only $194,000 in today's dollars. So now we've talked about what we might need, and we've laid out some sort of sobering statistics there, but I think now it's also important to talk about how to go about saving for your retirement. So there are a lot of good tax-advantaged savings vehicles out there that are available to you. We think about 401k plans and pre-tax dollars. There are Roth 401ks. There are employer matching contributions, traditional IRAs. So I want to spend the next little bit talking about each of these different types of tax-advantaged savings vehicles and who they may be appropriate for. So when I say a tax-advantaged savings vehicle, what is it that I really mean? So there's a huge value in the ability to defer tax, meaning the dollars that go into some of these plans come out of our money pre-tax, they're invested, and they grow tax-free. We don't pay income tax on the earnings every year. So let's say, for example, you invest $20,000. You have $20,000. You put $10,000 into a taxable account that earns 6% a year, and you use the earnings in that to pay the taxes that are due. Let's also say you put the other $10,000 into a tax-deferred account, such as a 401k, that also earns 6% a year. So if you're in the 28% tax bracket, in 30 years, your taxable account will be worth about $35,500, while your tax-deferred account will be worth over $57,000. So right there's a difference of $21,000. One was growing tax-deferred, the other you were paying tax on each year as it came along. Even if the funds that are invested in the tax-deferred account are subject to income tax when you take them out, which a lot of them are, it would still be true even if you took the entire amount in the tax-deferred account out in one lump sum distribution after 30 years and paid tax on the full amount, you would still end up with a little over $41,000. So most individuals actually draw on their retirement over time and gradually, meaning they would likely be in a lower tax bracket later. So when we think about this, the value of that tax-deferred growth is instrumental in your ability not only to save the money now and reduce your taxes, but also to let those earnings grow over time. So let's look at IRAs and 401ks. So when we think about a traditional IRA or an individual retirement account, these are personal tax savings vehicles, and they have some tax benefits, but these benefits are very specific. Even if you are contributing to your 401k or other employer-sponsored plan, you can also consider an IRA in addition to this. So we'll discuss the two types of IRAs, the traditional IRA and the Roth IRA. So both of these allow you in 2014 to contribute up to $5,500 a year. And that amount changes with an index, so it usually changes every year. Also, if you're over the age of 50, you can make catch-up contributions. So if you fall into this group, you can actually put an additional $1,000 in, or you can put a total of $6,500 in 2014. Both traditional and Roth IRAs feature tax advantages, and both give you a wide range of investment choices. However, it is important that the differences between these two types of IRAs, including the tax benefits and the qualifications, and it's important that you understand if you qualify and then make a decision if you do qualify, which one may be the best one for you. So let's talk about the traditional IRA. Almost anyone can contribute to a traditional IRA, and the only real requirements are you have to have taxable compensation and you have to be under the age of 70 and a half. I actually have a lot of clients that when their children start earning money and filing tax returns, as part of a gifting program, they'll actually open an IRA up for them and contribute to get the child started on the path to retirement savings. So the real question with the traditional IRA is whether or not you can deduct your contribution. And really that depends on whether you or your spouse are covered by an employer-sponsored 401k, a 403b if you work in the not-for-profit sector. Same, interchangeable. They're different sections of the code, but we use the terms interchangeably for planning. You can generally deduct the full amount of your contribution if you are not covered. If one of you are covered, then your ability to deduct this contribution depends on your adjusted gross income. So it's important that you consult with your accountant and your advisor around the deductibility of your contributions. Not everyone, though, can contribute to a Roth IRA. Roth IRA contributions are phased out for individuals as their income goes up. So whether you can make a full or a partial contribution or no contribution at all depends on your adjusted gross income and your tax filing status. And then unlike a traditional IRA, contributions to a Roth are made with after-tax dollars, so you won't get a deduction, but with both of them, your funds will grow tax-deferred. So now when we talk about distributions, so as we said, an IRA may or may not be deductible depending on your status. A Roth IRA will never be deductible up front. When the distributions come out, on a traditional IRA, distributions are subject to federal income tax. If you made non-deductible contributions, your portion that comes back to you is not taxable, and that starts to get a little more complex than we want to go here, but I do think that's another thing. It's important to track your basis if you've made non-deductible contributions. Distributions are generally available to you at age 59 and a half. If you take before then, as a general rule, you will pay a penalty, a 10% early distribution penalty. There are some rules around that. There are some exceptions, things such as disability or first-time home buyers. But as a general rule, think of an IRA as a long-term savings vehicle that could be subject to penalties if you take it before 59 and a half. When a Roth IRA distributes, the distributions come out federal income tax-free, and there are also some ways around that 59 and a half, or once you've met a 5-year holding period, there is also some ways around that early distribution. But it's important to remember non-qualified distributions for federal income tax, and there is a 10% premature distribution tax on any earnings portion. So big takeaway here is that it's the same thing I encourage people with their 401ks. Try and look at these as long-term savings vehicles, not as a place to go. There are certain with 401ks you can borrow funds. I really discourage people from doing so. Try to think of these as money that is tucked away for a very specific purpose and then leave it there for that specific purpose. So one of the questions that comes up is if you can make a contribution to both, should you, and which one is the right one for me? So we've talked about both traditional and Roth and which one you should choose first, but it's really a lot of it is if you're not able to deduct contributions to a traditional IRA because of either income, your filing status, or the fact that you're covered by an employer plan, you may be better off with a Roth IRA. if you qualify to participate. But if you qualify to make tax-deductible contributions, then you really need, should you contribute to an IRA and receive the current income tax deduction, or should you make an after-tax contribution to a Roth IRA? So a lot of professionals in the industry believe the Roth will long-term always give you more bang for your buck. But it really depends on your personal goals and your circumstances, as well as the performance of the investments that you select. A Roth may very well make more sense if you want to maximize or minimize taxes during retirement and preserve assets for your beneficiaries. They have some special rules around them. But if it comes to the ability to save, and on an after-tax basis you can't save as much, you really need to run the numbers and say which benefit longer term for my own time horizon makes the most sense for me. The flip side, if you say I have a traditional deductible IRA, it may be a better tool if you want lower income taxes and if you can afford to save more, or if you expect your tax bracket to be lower when you retire than it is now. And then one final additional note is you actually can have both a traditional and a Roth IRA, but your total annual contribution cannot exceed the maximum limit. So that's that maximum of $5,500 in 2014 or $6,500 if you're over the age of 50. So another one I'd like to talk about is the 401k or 403b plan for those of you that work in the not-for-profit sector. So the 401k plan has become the most popular type of employer-sponsored retirement plan, and for very, very good reason. If you participate in a 401k, you really should be taking full advantage of maximizing your contribution by giving the maximum amount. In 2014, you can contribute up to $17,500 of your compensation to your 401k plan. And if you're over the age of 50, you can make an additional catch-up contribution of $5,500. So your pre-tax contributions are not included in your taxable income for the current year, and they provide you with an immediate tax benefit. So let's just give you an example. If you earn $100,000 but you defer $17,500, your taxable income would be the net of those two, or $82,500. So sometimes when we think about $17,500 and we say, I don't think I could part with that much money, it's important to also note that with the tax savings, oftentimes it isn't really a $17,500 change to your take-home pay. It may be significantly less, and looking at those numbers can help you realize that sometimes that savings isn't as expensive as you think it is. Both contributions and earnings in your 401k will grow tax-deferred. So they will grow tax-deferred throughout time, and then they will become taxable when you take them out in retirement. And this is the biggest one I will put out there. If your employer matches your 401k contribution, at a minimum, contribute up to the match. So what a match is an employer says, maybe for the first 6% of your salary, for every dollar you put in, I will match $1 or I will match 50 cents. That is free money, and the impact of that free money over time is amazing. So if your employer has a plan where they match, at a minimum, take advantage of that match. If you can't afford to save more than that, don't give away the access really to free dollars, and find the money from somewhere else to be able to participate that way. And then, of course, like anything, there are a few disadvantages. Your 401k is generally limited to the investment options offered by your plan. Although most plans have a lot of options for you, you are locked into the options that they give you. Also, distributions prior to age 59 and a half, 55 in some circumstances, are subject to that same 10% penalty. And although, and there are a number of exceptions to that, I do want to point that out. And then finally, access to your funds in your 401k is generally very limited while you are still employed. Another thing that we're seeing more and more of is the Roth 401k. So they may allow you to make Roth contributions. And much like the Roth IRA, the difference is in a traditional 401k, the money comes out pre-tax. That $100,000, you put the money in, $82,500 is taxable. In a Roth IRA, the contributions are after tax, meaning your taxable income would still be $100,000. I think for some people that's the hindrance, is that these truly are after-tax dollars. Roth 401k accounts are entirely free from federal income tax, and any distribution that represents a return of your own contribution is always tax-free, even from a penalty tax. But the earnings come out tax-free as well. So if we think about your 401k, when it distributes, that's taxable income. When we think about the Roth, when it distributes, those are actually tax-free. The limits on Roth 401k contributions are the same as the limits on a traditional IRA. For example, you can choose to make a $6,000 pre-tax contribution, and you can combine these. So you could make a $6,000 pre-tax contribution and $11,500 after-tax contributions, or really split your contributions in any way you wish. So it's not all one way or all another. In order for a distribution from your Roth to be tax-free, you still have to satisfy the 5-year holding period, and you have to be either 59.5 or disabled when you start receiving it. And then finally, Roth 401k contributions are treated the same as pre-tax contributions for all other purposes. Access to your funds is limited. You are limited to the investment options that your employer is providing you, and your employer may allow you to borrow from your Roth 401k the same way they do with a regular IRA. So like IRAs, deciding when you should make Roth contributions versus regular really is dependent on your own situation and where you are and its effect on its ability to, one, help you save now, and then also what you would like to do with those funds in the future. So finally, as I said, we were not going to talk about specific investment options, but I do want to take a couple of minutes just to talk about some general investment considerations related to retirement planning. We all know that there is a risk-reward handoff, meaning that investment risk and potential return go hand in hand. So if we look at primarily conservative fixed income type of investments, we know that those may be appealing because there's relatively low risk that you will lose your money. But however, if you just put your money in these types of investments, there's an enormous opportunity cost, and you may miss out on possible long-term higher growth. So there's also the danger that your investments may not grow sufficiently to outpace inflation, and that you may not have enough to meet that long-term retirement goal. So it's important to know that investments in stocks and mutual funds have higher growth potential, and they also have higher risk. But when you take into your account your age and your timeline, you need to pick an investment mix that will help you achieve those goals. And you also have to pick an investment mix that emotionally you're comfortable staying the course. So the first time that there is a downward blip in something, that it doesn't cause you to panic and then leave the investment behind entirely. So really, in the end, the investments you select need to fit your own level of risk tolerance, and you should also try and reduce your risk by diversifying out, looking at a variety of investments rather than throwing all of your eggs in one basket. And then finally, I always say this is not an autopilot. It's important to reevaluate. Your life changes, your circumstances change, so make sure that you're consistently looking at what's available to you and then reevaluating. And then the final topic I wanted to touch on here was looking at the role of insurance in your overall plan. So when we think about insurance is really nothing more than shifting the financial risk from you to a third party, so from you to an insurer. So during the years you're working, disability insurance, life insurance are extremely important types of insurance to have in place. Life insurance protects you and your family against the risk of premature death, so the loss of those earnings years, usually the time when you're really accumulating the most. But one thing, too, is you are 6 times more likely to use disability insurance at some point in your career than you are to use life insurance. So it's not one or the other, but don't neglect your disability. And if your employer offers you an opportunity to purchase additional supplemental disability, really take a serious look at that, because there is a lot of benefit to being able to really maximize what you can receive in the event of a disability. When we look at retirement years, there's the health insurance question and then really the long-term care insurance. I think health insurance is its own complicated topic, But when it comes to long-term care, we talked about your spending changing over time. Early on, you may be traveling and enjoying time with your grandchildren or hobbies. As you age, long-term care really becomes the biggest financial unknown. And there are some really great long-term care policies out there now that allow you to put a lump sum in and lock in a benefit for the future. I would encourage everyone on this phone to at least start to explore what long-term care insurance may do, because by removing that variable from your plan and looking at how much money you'll need in retirement, risk sharing in the long-term care space can allow you a lot more comfort and flexibility around how much money you need to get you through that 25 to 30 years of retirement. So finally, let's talk about implementing your plan. As we said, rules of thumb are great, but it's really important that you develop your own roadmap. We'd encourage you to start now. Wherever you are, whatever point you're at, start now. It's never too soon, and honestly, it's really never too late. So look at where you are, start those conversations. Invest regularly, make it part of your savings plan, put it into your DNA, and make sure that you purchase appropriate insurance coverage to protect you now and in the future, what you'll need in retirement as well as what your family needs. And this is dynamic. Your life is dynamic. Your plan is dynamic. So please review your plan on a regular basis and make sure that you've adjusted it accordingly. And if anything that you've heard today has brought up additional questions for you, we are going to have a Q&A session, so we'd be happy to try and answer some questions via the web. But also, feel free to talk to your banker, your contact here at Zions Bank, whoever it is that you work with, and start some of these discussions, because we always welcome the opportunity to have a further dialogue based on your own personal situation. So with that, I will hand it to the operator if you want to go ahead and open up the Q&A.
Thank you. To submit a web question, click the Q&A button on the lower left-hand corner of your screen, type your question in the open area, and click Send to submit.
Okay, so my first question was around IRAs and the amount that you can put in them. And the question was, can you only put $5,500 in, or do you just not receive tax benefits on an amount? So with an IRA, the statutory limit, so the limit the IRS puts out there is $5,500 this year. Unless you're over the age of 50, then you're allowed $6,500. And as I mentioned, this is in addition to what you can put in an employer-sponsored plan, which that limit is $17,500, and then also allows an additional catch-up for people over the age of 50 of, I believe, $5,500 this year. The next question is, can I have multiple IRAs? And the answer to that one is yes, you can. You can have both a traditional IRA and a Roth IRA. You can have multiple IRAs. But the key is your contribution to all of those IRAs cannot go over the limit. Also, I encourage people, oftentimes when you leave a job, so I may leave my employment and I might roll over my 401k plan into an IRA. If you do that, you then can use that to make IRA contributions too, but if you do that, then you can never take it to another employer into their plan. So if you're thinking about that, make sure you really understand the nuances. Along that same line, how can a person contribute more than $17,500? Would a 401k and a traditional IRA work? So I think we covered that, and the answer is yes. But then if you're still able to save more money, this is where you go from tax advantage savings, so IRAs, 401ks. Once you've maxed out those benefits, the next important thing is to max out just start your own personal contributions to a taxable account. Next question is a distribution from a regular 401k plan taxed as income or long-term capital gain? They are taxed as ordinary income. So that is one piece. You get the benefit of tax-free contribution, tax-deferred growth, but 100% of that contribution comes out as ordinary income. So here's one. I work for a very small company that doesn't offer a 401k. What are my options? So this is where that deductible IRA option is likely available to you. It's important to see what your spouse has available to them as well, because the rules around that, and consult with your CPA or your advisor, and they can give you more specific guidance that way. But then from there, your tax advantage options are relatively limited. But from there, what I would say is that you start an investment account where you manage it in a tax-efficient way to continue to maximize what you're saving with the retirement as the goal. So the question here is, does your group only work with those of high net worth? And if we're not in that category, what would you recommend? So within the bank, we have a variety of different types of advisors, bankers, wealth advisors, and others who work with clients in different areas. So I would encourage you to start that conversation with your banker, with the individuals in the branch. Talk a little bit about your situation, and we can get you then to the best resource for you and make sure that we can meet. Our goal is to really try and serve the needs of all of our clients, and it's just a matter of how we go about doing that. All right, let's look at, I have another question here. If I have multiple IRAs at 70 and a half, do I need to start drawing from each of them, or can I draw on one to satisfy the rule? So what he's referring to is with an IRA and a 401k as well, at age 70 and a half, you have what's called a required minimum distribution. The way that works is you're actually allowed to take it from one. You have to use all of them to calculate what that RMD is, but you can then take it from one account. Usually the servicers of those accounts will send you a letter saying what that is. This is a key difference between a Roth and a traditional. A Roth IRA does not have a minimum required distribution. So for individuals who consider they may never need this money and they don't want to take it out of that tax-advantaged piece, that's where a Roth can be pretty meaningful. All right, well, I think we have made it through all of the questions that have come in. We thank you very much for your time. And as always, this will be available on our website as well, and we always welcome the ability to have a personal conversation with you and address any questions you may have as well.
Thank you for joining us today. We hope you found this webcast presentation informative. As a reminder, an archive of this presentation will be available 72 hours after this broadcast. This concludes our webcast. You may now disconnect. Have a good day.